The Federal Reserve just dropped its latest Beige Book, and you know what that means? It's time for us to do a little economic detective work. The clues inside this report, they could impact everything from your savings account to your job, so let's get right into it and decode what the Fed is really telling us.
So first off, what even is the Beige Book? No, it's not some dry, dusty report filled with spreadsheets. Think of it more like a collection of stories, real conversations the Fed has with people on the front lines of the economy. We're talking factory managers, shop owners, farmers. It's how the Fed takes the pulse of the nation, one story at a time.
So, here's our game plan. We're going to start with the 30,000-foot view, the big picture. Then, we'll zoom way in to see how the country's divided regionally. After that, we'll look at which industries are winning and which are losing, tackle the thorny issue of rising costs, and then, the big one, try to figure out what this all means for the Fed's next move.
So what's the main headline from this report? On the surface, the U.S. economy has shown little to no change. Now that sounds kind of boring, right? Well, trust me, that simple phrase is hiding a whole lot of complexity and a pretty uneven reality just beneath the surface.
The key phrase of the day is cautious stability. The economy's not exactly booming, but hey, it's not falling off a cliff either. It feels like we're all just stuck in a holding pattern, and that's creating this very real sense of uncertainty for, well, pretty much everyone.
Let's look at the key forces pushing and pulling the economy right now. First, consumers are starting to tighten their belts a bit. Manufacturing, it's getting hit from two sides, tariffs and just weaker demand. The job market is holding steady, which is good, but it's not really growing much. And all the while, prices are still creeping up, which only adds to that feeling that nobody knows what's coming next.
But, that's just the national story. To really get what's going on, you have to look at the map, because the economy feels very different depending on where you live. It's not a one-size-fits-all situation.
And this right here shows you exactly what I mean. This breakdown of the 12 Fed districts, it is a real mixed bag. You've got places like Boston, Philly, and Richmond on the East Coast chugging along with some growth. But then you look over at New York, Minneapolis, and San Francisco, and they're actually shrinking a bit. And the whole middle of the country, pretty much just treading water.
It really is a tale of two economies. You've got the East Coast, which is holding up pretty well, mostly thanks to strong finance and business service sectors. But then you have the Midwest and the West Coast, where struggles in manufacturing and farming are really starting to bite. Okay, so we've looked at the map. Now, let's slice this pie a different way. Not by region, but by industry. This is where we see who's managing to stay afloat, and who is really struggling to keep their head above water.
This chart gives us a quick snapshot, and it's basically a perfect split. You've got three major sectors just holding steady, and another three that are clearly in negative territory. Let's dig into who's getting hit the hardest.
First up, retail. It all comes down to price sensitivity. High-income shoppers, they're still spending, especially on things like travel and experiences. But it's a different story for low- and middle-income households. They're feeling the pinch, cutting back, and hunting for bargains, and that's putting a real drag on the whole sector.
Next, manufacturing. Man, this sector is just caught in a vice. On one side, tariffs are jacking up the cost of materials. On the other, cautious consumers mean there's weaker demand, so they can't sell their stuff as easily. It's a classic squeeze on their profits.
But the sector that is under the most severe pressure, by far, is agriculture. And this quote from the St. Louis and Kansas City Feds says it all. High input costs and low commodity prices are hurting farm incomes, with some producers facing bankruptcy. Just let that sink in.
And the sentiment score for farming reflects that intense pain, a brutal -2. That's not just a slowdown, that indicates a sector in genuine distress.
So let's be crystal clear here. This isn't just some mild downturn for farmers. It is a full-blown crisis, driven by a perfect storm of high costs, low prices, and shaky trade policy. And honestly, there's not a lot of relief in sight.
And all of this brings us to the main villain of our economic story, inflation. Across almost every region, every sector, the dominant theme was this relentless pressure from rising costs. Let's trace how that's actually working its way through the system.
It's like a chain reaction, right? It starts with shocks like tariffs or higher insurance premiums. Businesses feel that immediately. Their costs start to accelerate. Naturally, they try to pass those costs on to us, the customers. But, and this is the key part, consumers are pushing back. They're saying no way. And that's forcing a lot of companies to just eat the costs, taking a big hit to their profits.
So what's the bottom line here? Even if we're not seeing all of it on the price tags at the store just yet, the underlying cost pressures for businesses are definitely building.
You could say the inflation pipeline is really starting to heat up.
Okay, so we have flat growth, a divided country, some sectors that are really hurting, and accelerating costs. What on earth does this all mean for the Federal Reserve? And maybe more importantly, what does it mean for us?
This little number right here is the average sentiment score across all 12 districts. It's just slightly negative, which basically confirms that the overall economy has a slight downward tilt. There's just no real forward momentum.
And this puts the Fed in an incredibly difficult spot. I mean, think about it. Those accelerating costs are screaming, don't you dare cut interest rates, because that could just make inflation worse. But the stagnant growth and nervous consumers are screaming, don't you dare hike rates, because that could tip us into a recession. They are truly, truly caught between a rock and a hard place.
So what does this likely mean for you and your wallet? Well, the most probable outcome is a prolonged pause from the Fed. That could mean interest rates on things like mortgages and car loans stay pretty much where they are for a while. For the stock market, it probably means you'll have to be picky, because some sectors will do way better than others. And a big thing to watch, we'll all be keeping an eye on whether consumers start to have trouble paying their bills.
And that really is the million-dollar question we're left with. The Fed is walking a tightrope. One wrong move could send inflation soaring. A misstep in the other direction could push us into a recession. The stakes just could not be higher, and this Beige Book has given us a front-row seat to the whole balancing act. We'll be watching very closely to see what comes next.
Bye.